We just finished going through JPMorgan's CY2026 Q2 earnings call materials, and now we want to share our takeaways with you. Here's the thing. On paper, this was a monster quarter, a blowout, all four engines running hot at the same time. But management themselves said this is close to as good as it gets, and they don't know how long it lasts. So the real question stops being how fast can they grow, and becomes how long can they hold this peak. Stick with us, because the numbers underneath tell a very different story than the headline does. The company reported earnings per share of 7.70 against a street expectation of 5.55, a beat of nearly 39%. Now pay attention to the footnote. The filing shows reported EPS was actually 6.43 once you include significant items. Revenue came in at 57.35B, up 15% year over year, and return on tangible common equity hit 23%. Think about that, a 23% return on tangible equity that is elite, top of the league banking. The company also announced the dividend goes to 1.65 a share, the 15th straight year of hikes. And here's the line that matters. CEO Jamie Dimon said it's getting close to as good as it gets, and we just don't know how long it's going to last. Our take is simple. The whole investment thesis shifts right here, from pricing in growth to pricing in peak sustainability. So how does this machine actually make money? The company frames it as one simple equation. Net interest income from spreads plus fee income from investment, banking, wealth, and trading equals a universal earnings ecosystem. Think of it as a financial department store. Everything a customer needs sitting under one roof. On the consumer side, consumer and community banking runs retail, credit cards, auto, and mortgage. The filing shows over 500,000 net new checking accounts added just this quarter, real-time proof of that primary account moat. Then you've got the corporate and investment bank handling banking and markets and asset and wealth management sitting on $5.1 trillion in assets under management. Add the corporate treasury segment on top, and the company sits at roughly 907B in market cap, the apex of the whole industry. Our read, no single competitor touches this breadth, and that scale is the entire story. Here's where it gets loud. The company laid out the growth by segment, and every single engine is firing at once. The corporate and investment bank was the primary driver, with revenue up 27% to 24.9B. Consumer banking rose 8% to 23B. Asset and wealth management jumped 19% to 6.9B. And the corporate segment added another 6.0B. Drop it all into the engine block, and net income for the quarter landed at 16.9B. Sounds perfect, doesn't it? But here's the thing, and the company flagged it themselves with a diagnostic alert. 4 cylinders firing all at the same time is a defining characteristic of a cycle peak, not a launch pad. When everything is already maxed out, which way is the next move really going to go? Our take, the only direction left for mean reversion is down, and a quarter where nothing is weak is usually a ceiling. Now let's talk about the number that jumps clean off the page. The company reported equities trading revenue in the investment bank up 86% year over year, 86%. That is not a normal quarter, that is an anomaly, with strength running across derivatives, cash, and prime. Investment banking fees rose 30%, FIC was up 6%, all driven by large equity capital markets and M&A closings. But here's where you have to be honest with yourself about what you're looking at. Management explicitly called this combination difficult to replicate, and they admitted to a pull forward in investment banking revenues. Read that carefully. The brightest engine of the whole quarter comes labeled by the company itself with high base pressure for the back half of the year. Our take, when the deals get pulled into this quarter, they simply are not there in the next one. So the best number on the page is also the one most likely to fade, and you do not extrapolate an 86% spike. This is my favorite kind of slide, the one where you translate what management says into what it actually means. On broad strength, the company says all business lines are strong, and the analysts acknowledged it flat out. But the second level read, our read, is that simultaneous strength equals a cyclical high, and it's dangerous to extrapolate that as your new baseline. On expenses, management said they can afford to invest while keeping returns high, and analysts McGratty, Mitchell, and Mayo pushed hard on whether that holds. The honest interpretation, the company is packaging a 2.5B expense upgrade as a sweet burden, not as permanent operating leverage, which they admit won't happen. And on succession, management said the timeline hasn't changed and it's up to the board, while Austin, Najarian, and Mayo pressed it over and over. Here's the tell. The repeated emphasis on no change proves this is the single biggest unresolved anxiety hanging over the market. Let me put this quarter on a map. Picture a profitability curve that rises, peaks, and then glides back down. The company plants CY2026 Q2 right at the very top of that curve in what they call the sweet spot. What makes it so sweet? High spreads, high trading volumes, and pristine credit, all three lining up at the same moment. That combination does not last forever, and management clearly knows it, because they're already pointing at a 2027 to 2028 glide path. Now, here's the nuance, and it really matters. Dimon is not calling a crash here. What he's showing is acute peak self-awareness, flagging a slowdown in 2027 and 2028 himself. Our read is that management is actively engineering a controlled descent for market expectations, moving the narrative from infinite growth toward peak maintenance. Think about why a CEO does that. You only start managing people down from the top when you're pretty sure you're standing on it. A 2.5B expense hike sounds scary on its own, so let's actually do the forensics on it. The company walked it through in steps, so start with the original guidance, then add 1.5B. What is that 1.5B? The filing calls it the sweet burden, direct variable compensation driven by 6.5B in excess revenue the capital markets complex generated in the first half. In plain English, they paid their people more because the business made a whole lot more. Then add another 1.0B, which the company describes as true forward-looking expense buffers for the second half of the year. Stack it all up and new full year 2026 guidance lands at L175B. Here's the forensic conclusion, and it's the important part. On the surface, the year-over-year operating leverage looks negative. But the bulk of this revision is purely variable cost tied to outperformance. So our take is don't fixate on the raw expense dollar. Keep your eyes locked on the return rate. Net interest income is the bank's bread and butter, so where is this upgrade actually coming from? The company put total full year 2026 net roughly under 5.5B, so let's break it apart. You get markets NTI of around 9.0B, and X markets NI at 96.15B, which is the piece that got upgraded. The primary high quality driver, per the company, is deposit balance growth across wholesale and consumer, structurally shifting into higher spread products. That's the good kind of growth, real balances moving into better economics. But there's a secondary driver worth flagging. About 1.5B was simply shifted from X markets into markets NTI due to balance sheet mix and higher trading equity allocation. That's reclassification, not brand new money, and you should read it that way. And here's the warning the company prints itself. That higher exit run rate is strictly conditional. It assumes the yield curve perfectly follows forward rates. I'll respect that caveat. This is a modeled outlook, not a guaranteed reality, and rates rarely do what the model says. Why does JPMorgan trade like the apex predator of banking? The company lays out three pillars holding up that 900 CMB market cap. First, scale and synergy. Loans create deposits in a positive feedback loop, and the filing shows wholesale deposits significantly beat expectations this quarter. Second, capital density. The company is running a fortress balance sheet with a 14.1% CET1 ratio and roughly 4B in excess capital just sitting there. Third, return discipline. Management holds a rigorous 17% target deployment threshold and flatly refuses to carelessly deploy buybacks at 3 times tangible book value. That's a company that will not overpay for its own stock, and that discipline is worth a lot at these prices. But here's the flip side, and it's really the whole point of the slide. The wider the moat and the larger the scale, our read is the more severe the marginal impact becomes when any single engine inevitably stalls at these altitudes. Being this big and this dominant genuinely cuts both ways. Alright, here's radar alert number 1, and the status on it is unresolved. This is the unexploded ordnance. The timeline for Dimon's departure remains intentionally obscured, and that's not an accident. Management keeps repeating it's the board's decision and the timeline is unchanged, effectively dodging aggressive probing from top analysts including Houston, Najarian, and Mayo. Meanwhile, there's a real personnel shuffle happening underneath. The company elevated Doug and Troy to co-presidents to pave the way, while Marianne retires. An analyst, Mike Mayo, specifically challenged putting Troy, an options trader by background, in charge of the vast consumer division. So what's our verdict here? This deliberate dodging makes Succession the single largest unpriced personnel landmine currently hovering over the firm's valuation multiple. Think about it, this is the one company where the CEO is the brand, and nobody will tell you when he leaves or who truly takes over. That kind of uncertainty is simply not in the price yet. Now the rest of the radar, alerts 2 through 4, the landmines nobody is pricing in. Alert to equities high base status pending comparison. The CFO admits that 86% equities trading quarter is virtually impossible to replicate. Our read is that this sets up an inevitable Extremely tough comparative baseline for the second half of the year. Alert 3, credit deterioration, status mild weakening. Management notes mild deterioration in underwriting standards across the industry, aggressive revenue assumptions, more payment in kind, and weaker covenants. They flag data centers as the bellwether, and the company says it has already passed on several deals, with Dimon warning of impending outliers when the credit cycle turns. Alert 4, deposit convexity, status overdue. Analyst Barnum notes the negative convexity on deposit betas is overdue. While it hasn't severely hit margins yet, the company says structural logic and historical precedent dictate that it eventually will. 3 quiet risks, all quietly building underneath one very loud headline. Everybody wants the AI angle, so here it is, and it lands as a genuine paradox. On scope, the company identified nearly 1,000 AI use cases, but only around 50 were deemed important. Certain divisions are already seeing 30 to 40% headcount reductions, so the efficiency gains are very real. But then comes the CFO reality check. The real variable cost here is token fees. Those fees are negligible in the first half, but the company says they will accelerate significantly in the second half, with a strategy leaning on open source and matching the right model to each use case. And here's the quote that reframes the whole thing. Management said the ultimate beneficiary of AI is the client, not the bank. If banks could monopolize the tech gains, they said 20 years of computerization would have already pushed margins to 80%. Our take, and the company's own conclusion agrees, AI in banking is a defensive arms race, not a winner-take-all margin machine, and that's a crucial reality check for tech-level valuation fantasies. So what does a disciplined bank do with roughly 40 billion of excess capital? The company runs it through one gate. That gate is the 17% ROI threshold and the buyback rule, and Dimon's rule is refreshingly old school. Buy less when the stock is high, buy more when it's low. Because buybacks are an investment, not an automatic cash return mechanism. Where does the capital actually go? The primary use is organic growth, tech investment, branch expansion, strategic hiring, and building Chase UK into a pan-European digital bank. Second, they're leaning into macro themes, global infrastructure, remilitarization, trade reconfiguration, and government deficit funding. And on M&A, the company is open to acquisitions, but explicitly refuses to use a deal as a band-aid to cover up weakness in the core business. Our take, this is exactly the capital discipline you want to see at a cycle peak. When everyone else is overpaying, they simply wait. Let's land the plane and let's put it on a scale. The bull case is the current state, 4 cylinders firing 23% ROTCE and tie iron credit upgrades and fortress capital. The bear case is the future state, peak cycle acknowledged, equities facing a high base, mild credit loosening, pending deposit convexity, and that unresolved succession. And the stock, it's trading at a 1605 PWE, sitting right near its 52-week highs. So the market is paying up for the current state, while the real risks all sit in the future state. Here's your Q3 watch list. The 5 things to actually watch. 1. How much of that 86% equity spike is retained? 2. Do card net charge-offs hold at the roughly 3.2% revised guidance, or do credit outliers start to emerge? 3. Do consumer deposit interest costs suddenly accelerate? 4. Do expenses strictly hold near 107.5 billion if revenue begins to cool? And 5. Any shift in the co-president division of labor or timeline clarity on succession? If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.